Hi everyone, welcome back to the individual taxation classes. Now we are jumping into chapter 2 of Enroll Agent Part 1 examination. This chapter 2 is about income and assets. Right? In this particular video, we'll be starting all sources of taxable income. Right? So in this particular video, I'll be walking you through the wages, salary and tips, then the interest income, then dividend income, then rent and royalty income, gambling income, or the income from waiver of debt. Right? We may have couple of more video in continuation of that to understand in detail about all sources of taxable income. So let's dive into to understand these 6 topic in detail. Can you all see my screen?
Yes, sir.
Okay, so today we'll be discussing 2.1, which is type of incomes, right? In the type of income, you have sources of income and there are certain exclusion as well, and certain condition which an individual need to satisfy to consider that as an exclusion or maybe consider as an income. So first thing was wages, salary and tips. So all type of wages, salaries or tips which an individual receive is being taxable income and would be considered as a gross income, right? Second thing, if you see any withholding tax which is being deducted by the employer and deposited on your behalf is also being considered as your income. Any doubt on this point, or you need any clarification why it is my income?
All clear, sir.
All clear? So if your employer is deducting, withholding tax, that is also being considered as your taxable income. Next is any amount withheld by employer under any agreement from employee wages and salary. That is also being considered as part of your income. Any union strike benefit. So for example, in India also you might have seen a lot of labor union, they go on a strike, right? Even though they are on strike, but they are receiving the money, they are receiving the salary, and they are receiving some additional benefit also. So those all benefits, money or perks which they are receiving when they go on a strike, that will also be considered as a taxable income in the category of wages, salary and tips, right? Any long-term disability benefit received prior to the minimum age. For example, your client is working in a manufacturing company and unfortunately he has lost maybe his hand or leg or maybe any any part of his body, and now the company is paying them as a disability benefits throughout rest of his or her life, right? So that disability benefit which he or she is receiving from the employer would be taxable as a wages, salary and tips income, right? Next is the net earning from self-employment if the taxpayer own or operate a business, or the taxpayer is a minister or member of religious order, right? So that also being considered as a taxable income. And gross income received from statutory employees. So all such income would be considered in the wages, salary and tips. However, employer contribution to a qualified pension plan are not included in the employee income. So if your employer is contributing from his side to any qualified pension plan, so that is not considered as taxable income in your hand, whereas it is being considered as allowable expense to your employer, but still it will not consider as taxable income in your hand. Make sense? What all things comes under the wages, salary and tips? Any doubt or anything need clarification? Good. Second is interest income. So interest income include interest on deposit, interest on bonds, interest on debenture, interest on notes, interest on any certificate, or if you have purchased any bond on a discounted price, then the difference between the face value and the purchase price which you have paid is also being considered as interest income over the life of the bond which you have purchased. Exception to the interest income, that means interest income which are exempt, is from state or municipality bond or obligation, and the education saving bond interest if you have spent that for the education purpose. So then that interest income would be considered as exempt income, which we have recently seen an example for the state bond, right, and the municipal bond interest, which we have seen in a recent example, right, that is considered as an exempt income. Make sense? Any doubt on interest income? Yes, Rajat, Garima, Mayank,
No, sir.
Vikas?
No, sir. No, sir.
Looks easy?
Yes, sir.
Okay.
So far,
Okay, so next is dividend income. Dividend can be in cash or it can be in terms of property, right? So there are two types of dividend. One is ordinary dividend. Second is qualified dividend. So ordinary dividend is always being taxable at the ordinary tax rate, whereas qualified dividend is generally taxed at a lower rate. So what is the lower tax rate? If the ordinary tax rate is in a range of 0 to 15%, then for the qualified dividend tax rate would be 0%. If ordinarily dividend was being taxed at a rate of 15% to 37%, but if it is qualified dividend, then it will be taxed at the rate of 15% only. And if the dividend is being taxable for more than 37%, then if it is a qualified dividend, it will be taxed as a 20%. So in your question, it will be specifically mentioned whether you are receiving a qualified dividend or the ordinary dividend, right? So you have nothing to worry about it. Last one is fair market value of the property which is being received as a dividend would be considered as income. So when you receive any property as a dividend, so in that case of scenario, whatever is the fair market value of that property, so that fair market value will be considered as dividend income. Next is any distribution of the stock or stock right made to the preferred shareholder is taxable as dividend. To the preference shareholder, if you are issuing the stock right or if you are giving any stock dividend, that dividend or stock right would be considered as a taxable dividend in the hand of preference shareholder. Next is fair market value of the property received as a dividend income. Sorry, so I think I have repeated this two points. Sorry, this is duplicate. So this is about dividend income. Now look at the exemption side. Dividend should not be include first the capital gain distribution. What is capital gain distribution? When you are selling any property and you are receiving more money than the base price of that asset, and then if you are distributing that, is called capital gain distribution, and that would not be considered as dividend income, rather it would be considered as a capital gain income. Second is dividend that are actually interest. So for example, you have debentures, convertible debenture at the rate of, let's say, 4%. Instead of that 4% interest, you have given a stock dividend to them. So that dividend is not actually a dividend, rather it is an interest. So that need to be considered as interest income, not the dividend income, right? Third point is dividend on employer security paid by a corporation and held by employee stock ownership plan. So if you are receiving any stock under the ESOP plan, that will be considered as taxable income under wages and salary, not in the dividend income. Any dividend on the stock for which the taxpayer is required to purchase substantially similar or related property, then that dividend would not be considered as a dividend income. Rather, it is just a barter transaction. Fifth is payment in lieu of dividend. If the taxpayer knows or has a reason to know that the payment were not qualified dividend. For example, if you have to make payment to the shareholder for any service or goods he or she has rendered to the organization, but rather than paying back for the goods and services which he or she has rendered, you are giving him or her dividend, then that would not be considered as dividend income in the hand of shareholder. Rather, it would be considered as the income from the goods and services provided by that shareholder. Right? Sixth point is dividend reported as a qualified dividend from foreign corporation to the extent the taxpayer knows or has a reason to know that these are not qualified dividend. If you are receiving any dividend from the qualified foreign country, then that income you need to consider as a business income, not the dividend income. Next one is capital gain distribution are paid by regulated investment company. So there are certain regulated investment company or the real estate investment trust. If they are issuing the dividend in consideration of capital gain, then that nomenclature may be dividend, but actually it is a capital gain and hence need to be considered as a capital gain income, not the dividend income. Next one is stock split. Do not produce income for the shareholder. If, for example, earlier you are having one share of $100 each, now the company has split that to 10 share of $10 each. That has not resulted into any dividend. It is just a stock split. Hence, it should not be considered as a dividend income. Second last one is a return of capital until the taxpayer investment is recovered. For example, your company has, let's say, $1 million of equity, which all the shareholders have made, right? And now company is not earning any profit, but rather they are paying dividend from the capital, right? Would that dividend be considered as dividend income, or it is just return of your capital? So actually it is just return of your capital to the extent you have invested the capital amount. If the company is not making the money, company is not earning the money, company is not earning the profit, and dividend is not paid out of profit, right? But if the company is paying over and above the capital, despite of the fact the company has no earnings, no profit, then that dividend would be considered as a capital gain, because the amount the company is paying is the appreciation, not the earnings. Make sense? Any doubt on dividend? What is taxable dividend and what dividend should not be considered as dividend income, rather considered as business income or capital gain or wages salary? Any doubt here, guys?
Not yet.
Rajat, Garima, Divya, Shubham.
No,
So
sir.
far, so good?
Yes, sir.
Okay. A quick note here, individual with modified adjusted gross income over certain threshold amount must pay net investment income tax. If they have net investment income, that is 3.8% tax or the lesser of net investment income on the modified adjusted gross income. So the threshold for the current year is $250,000 if you are filing joint return. If you are filing separate return, it is $125,000. But if you are filing as a head of household or if you are filing as a single, it is $200,000. So if your income is more than $200,000, $125,000 or $250,000 as your status would be, then you need to pay additional tax of 3.8% on the investment income which you have earned, right? Next is rental income or royalty income. So royalty income, very straightforward. You can consider as gross income as and when you receive the royalty, not accrued, as and when you receive the royalty. Rental income, from here we have got the question. Rental income include all the amount that is received as a rent on a whether it's cash basis or accrual basis of accounting method, whatever you are chosen. So all amount received, that means when it comes to rental income, it follow cash basis of accounting. Whether for the book purpose you are following cash basis or accrual basis of accounting, it does not make any difference for the tax purpose. Tax purpose says if you have received advance rent, it will be considered as a taxable income, right? Any honor expense paid by the tenant. For example, you have a tenant and he is paying expenses for the whitewash or any repair and maintenance, which you are supposed to pay, right? So the expenditure the tenant is making on behalf of the owner, of the landlord, that would also be considered as a rental income. Third is advance rent will be recognized in the year received even while using accrual method of accounting. Do you remember the question? Third question, which we have seen for the rental income. You got the right answer now? Why we have considered that cash basis of accounting for rental income for tax purpose? Yeah, Mayank, Rajat, Vivek.
Sir, clear answer.
Huh? Are you guys with me?
Yeah, with you.
Okay. And now, non-refundable or adjustable security deposit. If you have received the security deposit, which you are not supposed to pay in future, or which is being adjustable against the future rent, that security deposit will be considered as rental income. But if you have received the security deposit which you need to mandatorily pay back, then that should not be considered as rental income, right? So rental income for the personal residence is considered when rented out for more than 14 days. So if you are renting out your home for more than 14 days, then the amount which you are receiving is considered as rental income. If you are renting out for less than 14 days, it would not be considered as rental income, right? And if you are considering it rental income, then you need to proportionately consider the expenditure, and you can reduce against the rental income the expenditure you have incurred for those respective days. So that is about royalty income and the rental income. Any doubt on the royalty and rental income? Shubham, Rajat, Vivek, Mayank, Vikas, Garima, good? So far so good?
Yes, sir.
Yes, sir.
Okay. So the next one is gambling income. So all the gambling winning are included in the gross income, whereas losses are being deductible as an itemized deduction, but only to the extent of winning. So you cannot deduct the gambling losses more than the gambling winning, right? So upper limit is the gambling winning. If you have win, let's say $5,000 under the gambling, but you lose $6,000. So maximum allowable loss is $5,000 to the extent of winning. So that $1,000 will not be allowed. Make sense? Yes, no?
Yes.
Right? And the
Yes.
second important thing, under the Tax Cut and Job Act 2017, the law is clarified that the individual expense for traveling to and from the casino are only deductible to the extent of gambling winning. So for example, you have gambling winning of $10,000 and you have, let's say, loss of $5,000 and you have invested $500 on coming and going back to casino. Then your net gambling income would be $10,000 minus $5,000 of loan loss and minus $500 of your travel expense to casino and coming back. So your taxable gambling income would be $4,500. Make sense?
Yes.
Okay. So next one is income from the waiver of debt. What is the waiver of debt? When that debts will get cancelled, maybe on account of bankruptcy, insolvency, as a gift, or maybe for any reason you are not able to recover the money and then you are ready to forgive that amount. So that would be considered as taxable income. But there are certain exceptions to it. First is cancellation of debt because of gift. So then it will be considered as gift income and would be treated as taxable gift under the Gift Tax Act. So that will be treated altogether separately under the Gift Tax Act. Second is cancellation of debt under the provision of insolvency or bankruptcy. So when you are cancelling the debt, for example, let's say Kamal Chhabra has taken a loan of, let's say, $100,000 from Bank of America. And now Kamal has got bankrupt. And I would be in a position, let's say I have a property. I purchased, let's say, Lamborghini for $100,000 from the bank loan, and now I'm bankrupt. So what bank can do? They can take my car, Lamborghini, right? And whatever the amount they can recover from the Lamborghini, that is the amount they will be recovering, and rest of the balance is lost to them or waiver of the loan, right? So in that case of scenario, whatever the bank is waiving off, let's say that Lamborghini has a value of $80,000 and $20,000 the bank is waiving off. So that would not be considered as my taxable income because I'm already insolvent, right? I cannot pay tax on that $20,000 as income. It's not my income, right? It's a loss to the bank, but not my income. Make sense? Yes, no?
Yes, sir.
Next is cancellation of debt under the Paycheck Protection Program of the Tax Relief Act 2020. So this Tax Relief Act 2020 has came under the COVID situation, when there are certain debt waiver the government has made. So those tax waiver would not be considered as taxable income in the hand of individual to whom those tax waiver benefit has been given, right? The next is cancellation of certain qualified student loan. So like in India also, you might have seen like there are so many loan waiver for the Kisan, right? I'm sure you might have heard. Yes, no. There are like every year government do lot of waiver of the farmer loan. Yes, no.
Yes,
Yes
sir.
or no? Have
Yes,
you
sir.
heard
Yes.
about it or not?
Yes, sir.
Right? Same way in the US also, government also do waiver of certain loan, which include like student loan, farmer loan, and low income categories loan, right? So those loan waiver which government provide would not be considered as a taxable income in the hand of recipient of the benefit, which include cancellation of certain qualified student loan, qualified purchase price reduction, cancellation of debt that is paid in cash basis, cancellation of qualified farm indebtedness, and cancellation of qualified real property business indebtedness. And the last one is qualified cancellation of qualified principal for resident indebtedness, right? So all those waiver would not be considered as taxable in the hand of recipient because these waivers are comes under the different scheme of the government. The taxpayer must file the form 982 for the reduction of tax attribute due to discharge of their indebtedness. So that taxpayer need to file form number 982 to avail those benefits, right? So next we have foreign income and other income. So I got it, but I didn't get a chance to make the notes on that. So that maybe we can cover in next class, right? So far, if you have seen, we have covered the types of income, wages, salary,